You are listening to Charting Wealth for Friday, the 16th of December, 2016. Market up over the course of the day. Now, it could be topping out because we do see the market popping up about the same point for the last three two-day candles, but the market was up 0.47% as it's drawing the first day of the new two-day candle. We still have a very accurate trend line on the two-day chart, still above the weekly trend line, and we're still seeing the PPO, the price percent oscillator, move up. Derivative oscillators losing a little bit of its energy. Let's look intraday on the 4-hour chart and see what we see. It crossed over going down in the morning on the 15th of December. And then just basically we have two spinning green tops, lots of indecision. Market had peaked up very, very strongly, just rocketing up there on the afternoon of the 7th of December and then on through until about the 12th. Then slid sideways for a candle and then popped up again and now has really just sort of been deflating, sliding sideways for the last 2 days or so. So what does that mean for us? Well, it means that we are seeing the market perhaps top out a little bit. We still have strong upward potential on that, but we do have a crossover going down on that 4-hour chart. If we explore in depth what's going on with the 2-day chart, we still continue to see that angling up. So we still have lots of strong movement on the PPO, and we've lost just a little bit of steam on the derivative oscillator over the last several days. The real steam came out of the derivative oscillator back on the 2nd of December after all that build up over those many days we just discussed. So we'll continue to monitor what's going on and just sort of see how everything plays out, particularly after that Fed meeting. Now, let's jump into the S&P 500, up 0.41% for the day. Again, another up day in the market, but could be topping out. We'll continue to watch. Still have all the indicators the market's continuing to go up for the last 3 two-day candles. And again, this is just the first day of the latest 2-day candle, but the last 3 derivative oscillators we've seen maintain the same amount of energy actually built up from the 8th of December. And we've got a nice strong trend line on the 2-day chart, still above the trend line on the weekly chart. And of course, we added to the S&P 500 for you, those who are watching on video. I'll tell you what's happening on audio. On video, we put vertical lines indicating when the crossover occurred on the 2-day chart and then later on the weekly chart. Remember, we trend follow. We had a strong enough movement on the 2-day chart to eventually 1, 2, 3, 4, 5 candles later pull over the weekly chart into the same movement. Then what happened? Market backed off a little bit, then surged again strongly, allowing us to get in and safely ride the continued up movement. If the market had backed off and continued to move over and the weekly trend never really got firmly established, then we would have never looked to get into a trade. That's what we do. First rule we have is don't lose money. Second rule, make money. But if you lose money, you're not going to make money ever. We did see a pullback, a crossover going down on the 4-hour, the half-day chart in the afternoon on the 15th. So we'll continue to watch. Again, up day, but sliding down, losing that momentum according to our Heiken Ashi candlesticks. Okay, going to go back to our 2-day chart, and we're going to take a look at the Qs. The Qs was up the least of these 3 indexes, these 3 market indexes, up only 0.16%. But again, nice trend line. First day of the 2-day candle looks quite nice, and we just continue to see upward movement, upward momentum. The Qs continues to move up again. The NASDAQ 100 derivative oscillator gained energy. If we look intraday, what do we see? We see that the market's been sliding sideways for the last 2.5 days or so on that 4-hour chart. Not crossed over going down yet. But remember our problem with the Qs and the reason that we're not trading it at this point is because our weekly chart has not yet crossed over going up. Now, by the time the week ends, we may be able to actually call it on a confirmed weekly uptrend, but we can't do that yet because the PPO is not yet crossed over. Derivative oscillators losing downward momentum, in other words, gaining upward momentum, but we don't have that crossover yet. We may have it for the next week. Then we have the parameters that we set and demand, that is, both of our longer indicators are going, our longer charts, our 2-day and our weekly are going in the same direction. We have to have that. Otherwise, we don't feel confident because all things being equal, what's our rule? The market tends to move in the direction of the largest chart. That is, all things being equal, it tends to move in that direction. Always, always remember that. I tout it continually because it works. That's what we do. We do things that work. Now let's go to gold, down 1.37%. Gold's in a confirmed down move on the weekly, has been for quite a while, and on the 2-day chart. Now let's take a look-see at what's going on the 4-hour. It finally crossed over in the morning with that strong, strong down movement. It took a lot to finally bring that 4-hour indicator, the PPO, over. Why? Because the PPO, just like the MACD, the moving average convergence divergence indicator, and the price percent oscillator, one deals with absolute values, that's the MACD, and the price percent oscillator deals with percentages, which we've discovered that we like a lot better, particularly when looking at long charts over the long term. It just is more accurate for us, the PPO. But the problem with the indicator itself, with the way that we're using these moving averages, is when you have the market sliding sideways, even if it's paring down, it starts losing its ability to work really well for us. But we did see it cross over. Gold dropped to new lows, and again, it's been, it's a new low the first time in in quite a while. We're zeroing back on our charts, and we can't go back far enough to even show you when gold's been this low. So again, it did cross over. Those of you who were paying attention to our 4-hour charts and using them, of course, they did give you that signal. Will it go as low as 100 or so? That was the final bottom we got many months ago, back at the end of last year. But remember, gold did the same thing. It dropped way down in December and January and then took off again. So we'll wait and see. But if you did get into an inverse move on gold, that might work for you. We encouraged all of you to at least look at it. And if you felt good about it, to give it a try in your virtual trading account, just to start practicing and learning. That is where we are at the end of the day on Thursday as we go into the last day of the week in this holiday season. That is Friday the 16th of December. Then we'll get into the last week before Christmas, which will always be interesting. We'll continue to watch how this December effect continues to play out. We appreciate you being with us. We always love to hear from you at chartingwealth.com. You have questions, problems, concerns, go to the website and let us hear from you. Also, if you've not already signed up for our daily newsletter, why not? We send them out by the score every day. We forward to you the video link, the audio link. We like to have you follow us every day. Fill out that market worksheet, that daily market worksheet, and also go to the website, listen to all the training we have there. We've worked hard to put all this together for you to make it simple so that you can practice and get this down. Thank you so much. God bless you. If you appreciate what we do, please go to our YouTube channel, subscribe, and go to iTunes. Subscribe to our channel there. Give us a 5-star rating. Say something nice about us. We appreciate you so much. God bless you from chartingwealth.com, and Merry Christmas.